Netflix stock has dropped 43% in the past year. If that's the only number you heard, you'd probably assume something has gone badly wrong at the company. But stick with me because that number is only telling you part of the story, and the rest of the picture looks very different. Right now, Netflix is valued at $307.51 billion, with an enterprise value of $322.24 billion. That second figure adds in the company's debt and subtracts its cash, giving a truer sense of what it would cost to buy the whole business outright. And here's a timing detail worth knowing. Netflix reports earnings on July 16th, 2026, after the market closes. That's just days away, meaning fresh data is about to land that could confirm one story about this stock or completely flip it. Before we go further, there's something most viewers miss when they look at Netflix's price chart. Back in November 2025, Netflix did a 10-for-1 forward stock split. For every one share someone held before, they now hold 10, and the price per share dropped to a fraction of what it used to be. That doesn't change what an investment is worth, but it does explain why today's price, sitting around $73, might look unfamiliar compared to what long-time followers of the stock remember. Now here's where investors often get confused. A falling stock price doesn't automatically mean a struggling company. Look at what the business actually did. Over the past 12 months, Netflix brought in $46.89 billion in revenue and turned $13.37 billion of that into profit, a profit margin of 28.52%. Its gross margin, which is what's left after just the direct cost of running the service, sits even higher at 49.03%. But that's not even the most surprising part. Netflix's return on equity is 48.50%. In plain terms, that measures how efficiently the company turns shareholder money into profit, and a number that high is a strong signal. Its return on invested capital is 33.12%, well above the 12.18% it costs the company to raise money in the first place. When a business earns that much more than its cost of capital, that usually points to real competitive strength. So let's talk about the balance sheet, because this is where it gets nuanced. Netflix holds $12.29 billion in cash but carries $16.74 billion in debt, putting it in a net cash position of negative $4.45 billion. At first glance, that sounds like a red flag. But here's the twist. Netflix's operating income covers its interest payments 16.31 times over, and its debt relative to earnings is a low 1.12. On top of that, its Altman Z-score, a measure of bankruptcy risk, sits at 11.91, far above the safe threshold of 3. So while Netflix technically owes more than it holds in cash, its ability to handle that debt is extremely strong. Then why has the stock fallen so much? This is where valuation and sentiment come in. Netflix trades at a trailing P/E of 24 and a forward P/E of 22.71 with a P/E-G ratio of 1.09, a number near one that suggests its price is reasonably balanced against expected growth. Analysts are forecasting 11.90% revenue growth and 22.03% earnings growth over the next 3 years, and the average price target of $113.15 sits 54.94% above where the stock trades today, with 50 analysts landing on a buy consensus. At the same time, the stock currently sits below both its 50-day average of $82.40 and its 200-day average of $94.94, showing weak recent momentum, and its RSI of 37.33 is edging toward oversold territory. Yet short interest, the number of shares betting against Netflix, is a modest 2.40% of shares outstanding. Most investors clearly aren't piling on for further declines. One last detail. Netflix pays no dividend, but shareholders aren't empty-handed. The company bought back enough of its own stock to shrink its share count by 1.25% over the past year, delivering a shareholder yield of 1% without a single dividend check. So where does that leave us? Strong profitability, low bankruptcy risk, manageable debt, and $11.89 billion in free cash flow generated over the past year, set against a stock price down 43%, trading below its key moving averages with earnings just days out. The numbers behind the business look solid. The price action tells a more cautious story. So the real question is this. When earnings hit on July 16th, does Netflix stock finally catch up to what its business is actually doing? Or does the market already know something the numbers haven't caught up to yet?